right? So I want to go ahead and introduce Dr. Young, who has been working, I guess I've known Dr. Young for almost 20 years now, and is an amazing, amazing teacher and an amazing communicator. One of the things that we talked about in our materials was her ability to be able to boil down very complex issues and to be able to describe them in a way that is understandable and applicable. And so we're looking forward to doing that this morning. I do want to hit a couple of little points because Dr. Young has had an amazing career, and I'm actually going to read some of these because I can't keep up with all of them. I've been doing the same introduction for Dr. Young for almost 20 years. I talk about her time at Deloitte, I talk about her time teaching, talk about her teaching me, you know, so, and maybe me showing up to a class maybe a little late one morning or two.
I forgot that.
That was over 20 years ago, right, when Dr. Young was 15. But I do want to hit a couple of points here. So Dr. Young not only is a great professor, but has written articles in the International Journal of Hospitality and Tourism Administration, Tennessee CPA Economics and Politics, Journal of S Corporation Taxation, reviewed textbooks many times. Tons of articles over the years. I've read them, they're phenomenal. But I want to also talk a little bit about some of her awards she's received. American Institute of Certified Public Accountants awarded her honorable mention in the Bea Sanders AICPA Innovation in Teaching Award. She received an Outstanding Teaching Award from Lipscomb University, Outstanding Teaching Award from Jack Massey College of Business at Belmont. Named multiple times as the most inspirational professor of the Jack C. Massey Graduate School of Business. Faculty Member of the Year, Beta Alpha Psi Chapter, and presented with Belmont's highest faculty honor, the Cheney Distinguished Professor Award, back in 2005. She's phenomenal. Without anything else, we're going to go ahead and get started. Dr. Young, take it away.
All right, thanks so much. Thank you. All right, so this will be an overview of what changed in the Tax Cut and Jobs Act that passed at the end of December. The story of this Tax Act is two parts, and they work together. So what Congress has as its intended goal is to broaden the tax base and to lower the tax rates. So in choosing a tax system, Congress is choosing what things should we include in a tax base. They can make it very broad and tax most sources of income. They can narrow it with deductions and credits and exclusions and make the tax rate higher. So if Congress needed to raise $20 in tax, it could create a very narrow tax base where there's fewer things that are taxed and charge a 40% rate. So 40% on $50 of a tax base would be $20 in tax. Or they could look at that tax base and start saying, maybe we should take out some of the deductions, maybe we should take out some of the exclusions, maybe we should broaden the tax base, and if we do that, we could lower the rates. So if they made the tax base $100, if they doubled the tax base with loss of deductions, they could bring the rates down to 20%, and a 20% rate on $100 would still raise the same $20 in tax. So as of 2017, on the tax returns that'll be filed this current filing season, the tax base is more like $50 with a 40% rate. And what you'll see with the changes in this tax law is Congress has taken out some deductions that you're familiar with. They've pulled in some income that you might be used to having not be included in the tax base. So they broadened out the base to be more like $100 in taxable income, but compensated with a 20% rate. So broaden the base and lower the rates. And you'll see that theme throughout the changes. Congress touched income tax rules, tax-exempt organization rules, C corporations, and pass-throughs. Not all of the changes are permanent. So the things that are permanent, that means that Congress would have to act to change them, and until they act to change them, they're going to be on the books forever. The temporary changes means that Congress has set an expiration date on those provisions so that Congress has to affirmatively act to re-up them and continue them in the law. Individual changes and pass-through changes are temporary. C corporation changes and the tax-exempt organization changes are permanent. And the expiration date for most of the temporary changes is December 31st of 2025. At the very end of the presentation slides for this first session this morning, there is a summary table with some common provisions with their individual expiration dates. For the most part, the expiration is going to be December 31st, 2025, but there are a couple of exceptions to that.
So everybody here remembers the fiscal cliff conversation? We're going to have another one of those in a couple of years, so get ready for it.
And the chances that Congress doesn't touch these laws at all until December 31st, 2025, never say never, but the probability of that is probably zero. But
There's a lot of people with hurt feelings over this.
exactly, that will weigh in over the coming years. So in the individual tax law changes, kind of the main feature is this reduction in the tax rates. So we have in the 2017 rules, before these changes kick in, and let me say about the effective dates, most of these changes are going to kick in as of January 1st, 2018. So no change in the rules coming from this bill, with a few minor exceptions, for the tax returns that you'll file during this filing season for 2017. These rules will kick in as of January 1st, 2018. So they'll begin to be rolled into the tax system with estimated payments for 2018 for withholding. That'll kick in February next month. So 2017 has these rates that are on the first column, and then what is changing is in the second column. So we have in 2017 a 7-bracket structure that has been reconfigured in 2018. So bottom rate at 10% stayed the same, with approximately the same bracket definition. The 15% rate became 12%, the 25% rate became 22%, 28 became 24%, 33 became 32%, 35 stayed the same, and then the top marginal tax rate went from 39.6% down to 37%. So the goal is for every taxpayer in the individual rules to experience some sort of reduction in the marginal rates. But that is, so if you want to see for the single or married filing jointly what the bracket definitions will be, these next two slides define the brackets, and they are essentially the same as the old rules, just with a different rate applied. The reduction in the rates is, the second part of the story is the broadening of the tax base. So there are some deductions that you might be familiar with taking every year that have either been restructured or repealed, at least for this temporary time period. So under the 2017 rules for the return you'll file for this filing season, gross income minus deductions for AGI is an adjusted gross income number that's further reduced by the greater of a standard or itemized deductions, and then personal and dependency exemptions. That creates the tax base using the 7-bracket structure, calculate your liability, reduce it by a child tax credit, and that's your tax liability. What Congress did for the 2018 rules, most things that are above the adjusted gross income line stayed essentially the same, a few minor exceptions to that. But what's changing is below the adjusted gross income line. Congress has almost doubled the standard deduction for every filing status. Adjusting the standard deduction up and making it almost double means fewer people are going to itemize from 2018 on. That's a simplification measure, which means that if you are in the category where you're taking the standard deduction under the new laws, that means you don't have to keep track of receipts, and on an audit you wouldn't have to justify and validate your receipts with your own substantiation. You can take the flat standard deduction amount. And then in the itemized deduction category, Congress has restructured some of those so that there are fewer deductions in that category. Congress also repealed personal and dependency exemptions, and they have replaced it with a child tax credit that is more generous under the new law than it was under the old law, and a new family credit that accounts for non-qualifying children dependents. So no more personal and dependency exemption amounts.
So for our clients, and we're going to talk more about this in the individual side, but for the vast majority of our clients, they were usually phased out on the dependency exemption, generally speaking, and we're living in the phase out of the itemized deductions often. Most of our clients itemized, vast majority. And so there's actually some good news built in here that we'll talk about a little bit later,
Yes.
but we're going to get into this a little more deep in the individual session after this.
Yes, and if you were fully phased out, you won't experience that loss of deduction amount. And then Congress has created a new qualified business income deduction for partners, S corporation shareholders, any individual or entity that's receiving income from a pass-through entity. The qualified business income has been summarized into QBI, if you're cool. So the
By the
QBI
end of
deduction is
today,
the last thing we'll say.
you will all be cool and know what QBI
Exactly.
is. So,
That is the goal here.
like us tax people. You'll be cool like us tax people.
Exactly. But you'll probably be hearing your CPA all through busy season talking about QBI. That is what they're talking about, qualified business income. So the new standard deduction amounts almost double what the old rules were. No change in the additional standard deductions for those that are 65 or older and or blind. So Congress did not change the structure of those. So for taxpayers in those categories, they will get an add-on to the amount from the table. Changes in the itemized deductions for 2017 and for 2018. So here's one of the exceptions where something could kick in before January 1st of 2018. Congress reduced the floor for all medical expenses for all age groups to 7.5% of AGI. And then beginning a year from now, January 1st of 2019, the floor for deducting medical expenses will be 10% for everybody. A lower floor is more pro-taxpayer. I hope everyone has a healthy 2018, but if you experience medical expenses near the end of the year, it's more beneficial for tax purposes to pay them before the end of the year and get the 7.5% floor and to wait till 2019 to pay them and have a higher floor. So a lower floor is better for medical expenses. What's made the news a lot is the state and local tax deduction amounts. So under the 2017 rules, unlimited deduction for real estate taxes and either sales tax or income tax. What Congress has done with the 2018 rules is say you can still deduct real estate taxes and or sales or income taxes, but the maximum deduction in that category is $10,000.
This is a big deal.
This is a big deal.
This is a big deal for us. So, and for most of our clients, this is a big deal.
Some states, as we'll talk about a little bit later on, are trying to plan around this, but at the moment, if you have more than $10,000 in that category, the maximum you can deduct is $10,000 with no carryover. Home mortgage interest, there is a lower debt level that Congress imposed with the new law. So right under the 2017 rules, you can deduct home mortgage interest on your personal residence plus one other as long as the combined principal balance doesn't exceed $1 million. Congress lowered that limit to $750,000 beginning in 2018. Existing mortgages from 2017 can carry over with the $1 million debt limit into 2018 and beyond, but new loans will have a $750,000 limit attached to them. Home equity loan interest repealed under the law, and the miscellaneous itemized deduction category is also eliminated under the law, broadening the base by taking away deductions compensated with a lower rate that applies on what's left in your tax base. So that means unreimbursed employee business expenses, not deductible anymore, investment expenses, tax return preparation fees that are attached to the personal return are not deductible under that category.
Yeah, the biggest thing that we're going to experience here is going to be investment expenses. So
Yeah.
a lot of our clients have significant investment portfolios, and guys, that deduction goes away. So that's a big deal. And then on the home mortgage stuff, be careful, and we'll talk more in the individual session, but be careful about refinancing. Be careful about cash outs. Be careful about, obviously you've got a home equity line of credit that you love to be able to deduct, so you're probably going to try and roll that into a primary mortgage. Be careful of what you're at already, and make sure you don't hit above that 750.
Yes. Charitable contributions, if you're making a cash donation to a public charity, the ceiling currently is 50% of your AGI. It's going up to 60% of AGI. That's making that section a little bit more generous than it was under the old law. Casualty and theft losses have been repealed except for one narrow area. If you are experiencing a casualty loss with respect to a federally declared disaster area, there's still a deduction available, but this means that uninsured casualties from things like a home fire or tornado damage when it wasn't a federally declared disaster area. Those uninsured losses are no longer deductible.
For the folks that experience that, I hate to use this term, but as my brother Tracy's probably saying, that's a real bummer. It really is, because you've just gotten dinged with, potentially, got a house fire. I mean, depending on where your insurance levels are at, there's just a long list of things where when somebody has a casualty loss and we're dealing with it, they're already having to get up above the threshold historically. And so, I mean, it was a big deal. And so now, not only have you had a casualty, but now you don't get a benefit for tax-wise. So that's a big deal.
And that's part of the two sides of the story of the tax bill, that there's a broader base, so things that are deductions that created flexibility in the law, that when your year is a bummer, that you pay less tax, is compensated with the lower rate. So taking away some deductions that are knowable for the benefit of having a lower rate every year is the strategy from Congress. Alimony received and paid is no longer a deduction for those that are paying the alimony or income for those that are receiving the alimony. And notice that this effective date is a year from now. So for divorce agreements that are executed a year from now, January 1st of 2019, Congress is putting every payment within a divorce agreement on the same, with the same tax consequences, or creating the same tax consequences. So property settlements, child support, alimony, none of those payments will create deductions by the payer or income for the recipient.
So depending on, well, so one, it's grandfathered, right? So if you're already in one of these arrangements, nothing changes. But two, depending on which side of the equation you're on, maybe speed it up or slow it down. So
Yeah.
Just for the record, don't do it. Right, Claude? Claude Sr.'s in here somewhere. I'm going to get lit up. There he is right there. I'm going to get lit up after this. Yeah, don't do it.
But if it has to happen, then. The alternative minimum tax was in the news a bunch during the fall when Congress was debating the law, and it was the sincere desire of the tax writers in the House specifically to repeal the individual alternative minimum tax. That did not make it through the compromise process of the Congress, but Congress did raise the limits for alternative minimum tax so that fewer individuals would be subject to it. So a higher exemption amount and a higher income threshold for that exemption to be phased out.
And in relation to that, we're going to talk about that a lot in the individual breakout, and that has a neat offset for a lot of the people that are affected by those things that we talked about earlier, because state and local taxes, SALT, as well as the 2% AGI deductions, or AMT preference items. We're not going to talk about AMT today because nobody wants to talk about AMT, but at the end of the day, there's a little bit of an offset there. And then also, we got a lot of folks standing. There's like 20 chairs. You're going to have to come to the front, but there's 20 chairs up here, so feel free. And also along the side, there's about another 15 or 20.
The child tax credit was restructured. It's currently under 2017 law, $1,000 with a lower phase-out structure than the new law. So $2,000 per qualifying child under the new law. That's double the credit amount. And then Congress raised the phase-out limit so that more taxpayers would benefit from the child tax credit. That new policy is meant to compensate for the loss of personal and dependency exemptions. The child tax credit is eligible for every qualifying child under the age of 17. If you have children that could have been claimed as dependents under the old law that are over 17, they're eligible for the new family credit. If you have non-children that were being claimed as dependents, they're eligible for the new family credit. The family credit is $500 per qualifying dependent. There is a phase out for both of the credit amounts, child and the family credit. Child tax credit, there's a possibility for a refundable credit at lower income levels. The family tax credit, only non-refundable.
And keep in mind there's a difference. Credit, dollar for dollar, deduction, multiplied by your rate. So
yeah,
there's
credit's
big
better.
Credits are better.
The child tax credit, the kiddie tax rules, change in the rates that apply. So under current 2017 law, any child that has net unearned income will pay a tax at their parents' marginal tax rate. The new law changes that to use the estate and trust income tax brackets. So the table is there for the tax rate that the child would use to measure the tax on net unearned income.
And that's going to create a planning opportunity for some of our clients. It's not a material planning opportunity, but you can get a couple grand per kid. So if you've got 10 kids, maybe it becomes a little more material. So, but that'll create a planning opportunity, particularly for those who get the benefit of the graduated rates.
Yes.
So it really is going to be the biggest for our folks that are in the highest income tax bracket. So probably, today, before all this stuff comes in, $700+ thousand AGI.
And for younger children, year after year, that $1,000 can add, a couple $1,000s a year can add up. The Affordable Care Act shared responsibility payment is better known as the individual mandate in the Affordable Care Act. That is being repealed, but like, this is an exception. That does not kick in for January 1st of 2018. It kicks in a year from now, January 1st of 2019. Moving expenses, no deduction for moving expenses, no exclusion from income if they were reimbursed. It's part of the broadening of the base. The limited exception to that provision is if you are active duty in the armed forces and you're moving under a military order. Other than that, the moving expenses will become like alimony. There's no deduction and there's no income recognition. And then
and there's a big deal because a lot of times you pay moving expenses as part of a package to attract somebody. You don't get that deduction anymore.
Yeah, and they don't get the exclusion.
So you could get the deduction. So I guess it really probably going to have to. We'll see what the regs say, and I'm going to talk more about kind of the process that we're in right now. We're like 30 days ago today, right?
Yeah.
30 days ago today. So there's not a lot of guidance out there. We're at the law level, and then there's multiple levels. We get to regulations, we get to rulings, we get to guidance, and we don't have any of that yet. But generally speaking, I would think you're going to have one or two options. Either take it as a non-deductible expense, potentially, but generally I think it's going to need to be included in their W-2 income if you pay for that moving forward because the exclusion is gone.
Correct.
So
that
I think the
becomes additional.
non-deductible isn't going to be real practical, but we'll see what happens.
Yeah. And this bill is going to come in waves next year with new technical corrections. The estate tax, it was the sincere desire of those in the House to completely repeal the estate tax. That didn't happen in the compromise. So what Congress has done is kept the top rate at 40%, but upped the exclusion amounts. So it's almost double what it would have been under the indexing for inflation that would have applied in 2018 without the tax law. So $11.2 million is the exclusion for unmarried taxpayers, $22.4 million for married taxpayers. It is our assumption that the generation skipping exemption will go up proportionately with the changes, but that too is not completely in the law yet.
Yeah, it's not clear, but it would appear that at this point it's going to point to the same place. So
Yes.
We'll wait and see where the regs come out, but that's our intent. That's what we think is going to happen is GST, which some of you guys are familiar with. You'll hear us talk about GST. It's nice that it's at the same place,
Yes.
basically to make a long story short. So if it doesn't end up at the same place and it's back at the old rates, which are about half, that's a big deal. So.
And that's going to require some careful planning.
It is, and so estate planning had changed a lot. We used to do this for everybody. $600 million, over the course of the last 20 years, and then of course we bumped up over the last several years. Now we bumped up again. So now estate planning really is a much smaller piece of what we spend a lot of time doing. And I think what's happened, and this has already started, but we talk a lot more about asset protection planning now. But for those that do fall in the estate tax area, which we have lots of clients that do, even with the new standards, it becomes all that much more important because these are big estates. So.
And taking the exemption up to 11.2 is a good thing, and
It's a
22
great
is a
thing.
great thing.
It's a huge thing. We had a lot of clients that were in that, $15 to $20 million range that we were kind of middle of doing things. We're like, well, it's going to be a little different.
This last slide for the individual rules is a list of things that didn't change, but they made the news pretty frequently in the fall in the back and forth of the debate among the House and the Senate. So the credits for higher education didn't change. Same rules will apply in 2018 and going forward as they did in 2017. Student loan interest deduction, still allowable. Exclusion for the gain of the personal residence. Congress was debating about making that less generous than it is under the current law. They didn't touch that in the final bill. The educator expense deduction, still allowable, and there was lots of stories about the House wanting to lower the limits for contributions to retirement accounts. That didn't get changed in the final bill, which is a great thing. It would have gone down to a maximum exclusion of $2,500, so that's a great thing that didn't get changed.
That would have been bad.
Very bad. All right, so Congress changed individual rules, tax-exempt orgs, corporations, and pass-through. So part number 2 is a handful of things that changed in the tax-exempt org area. Congress repealed a substantiation rule, which the upshot of that is that the organization needs to acknowledge all donations. The donor can't rely on the 990 as validation for their donation. Congress imposed a new excise tax on excessive compensation. So reasonable compensation standards are still going to apply, but they have created an objective rule that if you're paying over $1 million to a covered employee, then a new 21% excise tax will apply to the excess compensation. That 21% number is tied to the new corporate rate. And then an excise tax on private colleges' endowment amounts. They're no longer going to be treated as a public charity. Instead, they'll be treated as a private foundation, and a new 1.4% excise tax is going to apply to excessive accumulations. The excessive amount is entity by entity determination based on how many students do you have and what's your accumulation. So a calculation will tailor that excise tax to the particular circumstances of the university.
In that substantiation requirement, a lot of you guys in our not-for-profit world, which we obviously do a ton of work with, are like, well, you've been telling me forever to provide contemporaneous substantiation. And yes, we have. The reason why is because that rule that's out there was built to where basically Treasury could write regs that basically talked about all those things that Dr. Young talked about, but big surprise, Treasury never really got around to it. And so Treasury, basically they took away the ability for Treasury to write those regs. So just to clarify that.
A little bit of change to the unrelated business taxable income rules. If you've got multiple business activities occurring within the same tax-exempt org, you used to be able to take losses in one activity and offset income in another activity. No more. You have to treat them all separately so that a loss from one activity can only offset income from that same activity going forward. And then some of the business expenses have been restructured to take away, in the base broadening philosophy, to take away some of the expenses that used to be business expenses, to not hit the tax-exempt organization area with the same restriction of deductions. They're still allowing some of them in the calculation of unrelated business taxable income. So the keys there is entertainment expenses can still be deductible even though they're repealed in the business area, as well as qualified parking and transportation cost.
So I just want to add one thought on that, because this is a pretty big deal. You know, we have several clients, a lot of clients with unrelated UBTI. And so basically, historically, as Dr. Young said, what we would do is all that would most of the time end up on the 990T. And it all went in there together. And you grabbed a bunch of other stuff generally, and we've done a lot of exercises over the years to try and bring that down, because you can bring other costs in, you can trace other costs, bring that in, bring that taxable base down to really help the nonprofit. Now, potentially, let's say that you had a magazine that you were selling a lot of marketing work with as a nonprofit, which of course, you know, is going to be unrelated business. But then let's say you had, and you were making a ton of money over there, but then you had another activity that was unrelated, and you were losing a lot of money. Those would offset. So now what's going to happen is those would be required to take into account, sort of like the old passive activity loss rules carry forward. So over the years, we've done a lot of what we call, Chris Griffin's somewhere around here, for-profit subs. So we take all that unrelated business activity and kick it down into a C corporation. C corporation pays tax at 21%. But our view of the world at this point is, once that's all in the same place in the C corporation, you're not in the 990 rules anymore. So at that point, it's all for-profit. Those things will offset again. So for those of our clients or for friends in the room, don't use this. That's a big deal. So and we've done that before. We've actually had them looked at by the IRS. We had a really high-level agent come in with the one we did about 10 years ago that we ended up getting almost, goodness, I don't remember, Chris, $300,000 or $400,000 back when we went back and amended a bunch of returns and did that. As far as bringing in those other expenses, it works. So.
And these changes in the tax rates and broadening the base is resetting the philosophy of choice of entity and how to structure, even within a tax-exempt org environment, a choice of entity change that can make the most of these new rules. In the C corporation area, under current law, we have this winding road of progressive rates that go from 15 up to a top rate of 35, and you'll notice that the rates bow out and then come back in and bow out again and come back in. Winding road of progressive brackets for a C corporation. The new law has flattened that into one rate, so 21% on all C corporation profits. To effect that change, Congress has made some other changes in other areas about how the tax base is determined. So C corporations, complete repeal of the alternative minimum tax. It was the sincere desire of the House to get rid of both alternative minimum tax provisions, individuals and C corporations. That didn't make it through the compromise process within Congress, but what did survive that is a complete repeal of the C corporation alternative minimum tax. That kicks in January 1st of 2018, and lots of C corporations are going to have alternative minimum tax amounts that they paid in prior years that, but for the law change, would have carried over and created credits. And so to effect an orderly process of unwinding the minimum tax paid in previous years going into a new year where there's no alternative minimum tax, that second bullet point is describing how Congress has set on a schedule for the next 4 or 5 years a way to get a refundable credit back on your alternative minimum tax payments that have been paid in prior years. And then going forward into 2022, after that window of time is up, then fully refundable, get it out of the system, alternative minimum tax no longer applies. In a base broadening philosophy, Congress has taken away some of the benefits of the dividends received deduction. So if a C corporation holds stock in another C corporation, there's the possibility that $1 of corporate profit can be taxed on multiple tax returns so that there's not double taxation, but there could be triple taxation or more if the shareholder group is full of C corporations. So under the old law, Congress had a schedule where a C corporation shareholder could take a deduction for dividends received from another corporation. They've made those rules less generous. So a C corporation owning stock of another C corporation with ownership of less than 20%, you used to be able to take a deduction of 70% of that dividend against your own taxable income. Now it's 50%. The 80% dividends received deduction has now become 65%. Control is kicked in a C corporation environment when you own more than 80% of another corporation. That 100% deduction hasn't changed. So for lower levels than 80% ownership, the dividends received deduction is a little less generous.
And the concept there is to basically get the math to the same place.
Exactly.
Because the rate's lower. Because
you're getting a lower rate. So broaden the base, lower the rate. The 21% flat rate for C corporations, Congress is assuming that that might prompt some S corporations taxed under the individual tax brackets to now want to go to a C corporation and get the flat 21% rate. So in anticipation of S corporations converting to a C corporation by revoking their election, Congress has created some, again, orderly process. If there's lots of revocations of elections, how should we tax that? So these are meant to be pro-taxpayer for revoking an S election. Whether or not that's a good idea or not, all facts and circumstances dependent. But if you do make a conversion from an S corporation to a C corporation, S corporations can use the cash basis of accounting, which means the tax base is cash receipts minus cash payments. C corporations, in only limited circumstances, can use the cash basis. So changing from an S corporation to a C corporation is going to prompt an accounting change to the accrual method of accounting that for some businesses is going to result in higher taxable income numbers during the conversion. So Congress has created a pro-taxpayer way to make that conversion. Whatever adjustments that you're making from going to cash to accrual can be taken into your taxable income calculation ratably over 6 years. Not all, you don't have to take it all in the first year of the conversion. And then
And that used to be 4, right? For the 481A adjustment. So just to put it in perspective, you could always stretch it but now you get to stretch it further. So,
Pro-taxpayer.
Yeah, and you're still making a change in accounting method, filing a 3115, all those things.
And the same pro-taxpayer philosophy about what to do with distributions. So if you are an S corporation, you can take withdrawals from your accumulated adjustments accounts, which is keeping track of all the taxable income you've reported that hasn't been withdrawn from the corporation yet. You take withdrawals from from an S corporation, it's not taxable. If you take withdrawals from a C corporation, it's a dividend that is subject to tax. Under the current law, you've got 1 year after revoking your S election before any undistributed S taxable income becomes part of the C corporation account that then becomes a dividend. So Congress has made a pro-taxpayer adjustment for revoking your S election, where after 1 year after your revocation of your election, where it, under current law would have become a taxable dividend, they're allowing you to keep both accounts concurrently and make part of your distribution after that 1 year coming from previously S corporation income that can be withdrawn tax-free, and part of the dividend will be taxable. So pro-taxpayer to create flexibility in the law if there's changes in legal entity structure.
And a little plug for the corporation session that's going to be happening. Tom Bates, Paul England are going to be leading that and getting into some of that a lot deeper, as well as the slide that we're getting ready to literally blow through. You're going to be like, goodness, that looks like some pretty significant stuff. So poor Dr. Young had like 15 or 20 slides on this stuff. We were like, hey, we're going to have to just go through and hand over to my partner Tom Bates back there. So good luck, Tom.
So to set up Tom, big picture is this is part of the base broadening for some of these changes, and some of them are pro-taxpayer. It's a combination of two things happening. This is the Tax Cut and Jobs Act. So part of the Jobs Act part of this is that Congress wanted to incentivize new investments in property, plant, and equipment. So immediate expensing of new property, plant, and equipment purchases under the 179 expense election rules has become more generous. You can deduct up to $1 million of new property, plant, and equipment investment, provided you don't buy more than $2.5 million. Then the phase out will kick in. And Congress has made the definition of what property is eligible a little bit more generous than it was under the old laws. Bonus depreciation has more favorable rates, and this is one of the exceptions. Bonus depreciation at 100% kicked in September 28th of 2017, the day that the House passed their bill. So if you made end-of-year purchases in property, plant, and equipment, you might experience a 100% bonus depreciation adjustment, even though this is part of the new rules that was retroactive.
I'm thinking someone in the lawmaking body might have bought a lot of stuff around that.
I think the right person at the right time got to the right member of Congress and got that in.
I think that's right. I think that's right.
So congratulations to you. There is a new limitation on interest deductions that related to business interest. So it's always complicated, right? But the big picture is a limitation that is, for most taxpayers, going to be 30% of their adjusted taxable income. That creates a bar. You can deduct interest up to that number, and then the excess amount gets carried over indefinitely.
And this is a big deal, but there's a nice carve out for less than 25 million that Tom's going to get into this in depth, but there's some calculations that come in. Banks, we have lots of banks we work with, don't worry. But there's a lot of caveats to what that looks like, but it can be a big deal for some people.
And this is all part of the base broadening, so taking away some deductions for some. Net operating loss deduction rules. Under current law, you can carry your net operating loss back 2 years and forward 20. Congress repealed the 2-year carryback and made the deduction going forward indefinite, with one caveat to that. The most you can deduct for a net operating loss in any year is capped at 80% of your taxable income, so that when you're taking a net operating loss, there's going to be some income left on your tax return. Like-kind exchanges are going to be limited to just real property. So no longer can you take equipment, personality assets, and use it in a like-kind exchange. Meals and entertainment have been restructured. So as part of the base broadening, Congress is taking away the deduction for entertainment expenses, but they did leave the 50% allowance for meals, and they broadened it to allow for employer-provided meals at the 50% rate. That's temporary, though. No deduction for local lobbying expenses, no longer a deduction for domestic production activities, and the transportation fringe benefits that are part of you can include that in unrelated business taxable income in the tax-exempt organizations. That rule is there to allow tax-exempt organizations to have a deduction that Congress just took away in the business area. All right, headed to the big finish here. The star of the show for many in the Tax Cut and Jobs Act is the changes in the pass-through entities.
Buckle up, here it comes.
Here it comes. We're going to be talking a lot over the next coming years on qualified business income deduction. And I'll remind you, if you're cool, call this QBI. So this is brand new in the law.
Yeah.
And the purpose of this new deduction is for investors in pass-through entities to have a deduction against their taxable income for business income, not investment income, business income coming from the pass-through entity. The rationale, the motivation behind this new deduction is to at least acknowledge and address that if you're going to reduce the tax rate on business income earned in a C corporation, without this adjustment, you could have a wide disparity between the tax costs on business income from a pass-through entity and income being earned in a C corporation. So at the widest distance, you could have a taxpayer in the top marginal tax bracket paying 37% on business income coming from a pass-through, while that same business dollar is taxed at 21% in the C corporation rules. The QBI deduction as a basic rule is structured as 20% of your business income. There's lots of caveats to that. Lots of great stuff in the pass-through breakout to describe caveats to that. But if you are eligible for the full 20% deduction, what that would mean for a taxpayer in the 37% marginal tax bracket, it means only 80% of your business income will be left in your tax base. So 37% times an 80% amount included in business in your taxable income would leave only 29.6% as the rate on business income. That's still a distance from 21%, but they're acknowledging that 21% for C corporations, top rate of 37%, we should give some considerations to the pass-throughs. If you're not in the 37% bracket, then you continue to get closer. As you multiply your marginal rate by 80%, you take steps closer and closer to the 21%.
And it's important, and we're going to talk a little bit, give some perspective throughout the day on this very point, because a lot of you are in here right now. Should I be a C corporation? And I'm going to not spoil it, but don't forget, all the things that still existed in a C corporation still exist. Double taxation, personal holding company rules. We're going to talk about it a little bit, especially in the corporations breakout. Tom's going to talk a lot about S versus C, or pass-through versus C. There's a lot of media on this right now, and it's not all right. And so we're going to talk a little bit. I'll give a little perspective at the end of this, but then we're going to hit it definitely in the corporation breakout, where we're going to cover S versus C, and then also in the QBI pass-through breakout. Chris will be ready to talk about that along with Jan Cole. So.
And just keep in mind that the short answer to every tax question is it depends.
It's always. It depends.
Always depends.
And it really actually does. We're not just looking for the easy way out, I promise. It really does. There are so many factors. And so we'll come back to it.
So Congress started with a basic idea of let's give 20% as a deduction for all business income coming from a pass-through entity. And then they started building in levers within this policy that incentivized some activities more than others. And so the big picture behind the QBI is that there are two types of businesses. So Congress has sorted every possible business that could be organized as a pass-through into one of two categories. You're either a service business or you're not. So then there are different rules for how you calculate QBI from service businesses and how you calculate it for I'm not a service business. And within those two categories, there are three possibilities that could happen for investors in the category. So if you're a service business, you have three possible outcomes for your QBI deduction. If you're not a service business, you've got three possible outcomes for your QBI deduction. So think about it as 3 rungs, and there are 3 levers within this policy. Your income matters, if you had employees matters, and if you bought property, plant, and equipment, it matters. So let me back up to the slide before for a second here. Nope, it's forward. Income matters. So if your income is below those numbers at the bottom of the slide, if you're unmarried, $157,500. If you're married, it's $315,000. If your taxable income before the QBI deduction is under those levels, then the QBI deduction is 20% of your business income. As your income rises, there's a phase out and a phase in.
Maybe.
Maybe, yes. It always depends. It always depends. As your income rises, some other levers are going to kick in. Income is going to take away your deduction, but paying employees and making investments in property, plant, and equipment will increase your deduction. So levers are going to move in 2 different directions. If you are a service business, the third possible outcome is your income gets to be a certain level and there's no QBI deduction for you at all. The motivation behind that, if you read the news stories about this, is we can't give hedge fund managers a deduction amount. So at some level, they cut it off and said, no deduction for you. But for the trader business, you're not a service business. The QBI can continue to be available once your income reaches a certain level, as long as you continue to have employees and property, plant, and equipment. So there are 3 different levers that are at work with this policy. Income matters, wages matter, and property, plant, and equipment investments matter. And in the pass-through entity breakout session, there'll be numerical examples illustrating how those levers work.
And just a quick teaser on this. So this referenced section 1202 of the code, talking about a service trader business, and it's a doozy. It basically, at the end of the day, and we'll talk about this extensively in the pass-through breakout, but there is a chance that basically, depending on where things come in at and what we see in the regulations, there's a phrase in there that says the entity, the business, the income depends upon the reputation or skills of 1 or more employees. Whoa. I mean, that's a big deal, guys. That is a big deal. And so normally you think, well, I'm not a service trader business. I'm not a hedge fund manager. I'm not an accountant. Somehow the engineers and architects got out of this thing. Again, a lot of
the right person at the right time.
Yeah, right person, right time. And that relates back to DPAD, and we'll talk about that, the domestic production activities deduction. But at the end of the day, this is going to be a really interesting conversation, because there are a ton of people that, if you narrowly construe section 1202, they're not going to get this, and you'd be thinking that they would, but they're not. You know, depending on AGI levels, depending on all sorts of carve-outs, but it's complicated. It's a big deal.
Correct, and there's going to need to be a technical corrections bill from Congress to clarify some of these application of the rules. So here's the definition of service. So accountants, lawyers, doctors, but not architects and engineers. The trader business, that's the performance of services and investments, is service. And then what CJ was just referencing is there's a final bullet point that you're holding yourself out and generating revenue based on the reputation of 1 or more employees creates a service business that gets less generous consideration in the QBI rules. All right, so some final thoughts here about this bill. This is a federal law. There's no guarantee states are going to adopt it. So if you think of things like really generous 179 expense elections, if you buy property, you can deduct $1 million of that cost in the year of investment. Lots of states can't afford that and are not going to adopt it. So there's going to be differences between calculating the tax base for states and for the federal government. And Congress could change these laws. So even though there are temporary provisions with expiration dates, they're probably not going to leave it alone over the next 8 years. The timing and bunching of itemized deductions, if you take the standard deduction up almost double, for those individuals that are at or near the breaking point of I can itemize or I've got to take the standard deduction, timing of when you make your payments can matter, and it might trip a tax planning strategy of putting multiple years of deductions in 1 year and then take the standard deduction next year. So alternating years might lead to, over time, more deductions.
And I don't want to spoil that. Scott's going to talk about that along with Dr. Young in the individual breakout. But that was an interesting nuance on a lot of times when we do this, but because of the change with the piece, the phase out deduction on the itemized, it actually is kind of reversed. Whereas that used to be a benefit for high net worth individuals, maybe it's not as much anymore. So it's kind of it's interesting. It kind of turned on it. And in that QBI conversation, just make sure you guys understand it's a temporary provision, which is really interesting, especially with permanent 21% corporate tax rates. So,
then, as we've been talking about over the last couple of sections, choice of entity, the rules have been upset by these new provisions, and for some, might be more beneficial to change your current legal entity structure to something else, and for some, staying the same might be better. Particularly since there's a permanent reduction to corporate tax rates, temporary provisions for pass-throughs. It all depends on your circumstances whether a change would be beneficial or not. And then kind of stay tuned. It's unlikely that Congress just passed this and said this is all good and forevermore we're just going to keep these rules. So Congress could change these rules at any time. The final set of slides is the individual expiration dates for some provisions. Most of the temporary ones will expire December 31st of 2025, but there are a couple of exceptions in here. And then you'll see the things that have been made permanent are identified in here as well.
Let's give Dr. Young a round of applause, please. Wonderful job. Complicated topics. And goodness, I hope everybody was hanging on because that was a lot of information. Don't forget, you can download materials and we're going to have recordings. I want to give a little bit of perspective on a couple of things just real quick. And I'm going to have to be pretty quick because we got to get to our breakout sessions. But generally, lower taxes across the board. But as always, it depends. With that comes a cost. So in lowering the taxes, we have all sorts of deductions, all sorts of different rules that have changed. And so depending upon your individual circumstances, you could find yourself in some scenarios actually paying significantly more tax. And so when we say it depends, it truly does depend. And so, planning for that is important. Running projections is very important. And at the end of the day, that's what we're here to do. So pass-throughs versus C. And I'm going to try and make this as quick while still not stealing too much thunder from my partner Tom back there. Generally, it still doesn't make sense. And that's crazy. Everybody's reading articles. There's all sorts of stuff coming out here saying, oh my goodness, you can put this in here and you can. So let me ask you a couple quick questions. Usually, for the most of us, what do we do with money that we earn? Spend it. There it was. That's what I'm looking for. We spend it, right? Which means it's got to get out of there. So when it gets out of there, it's going to come out as wages or dividends, right? So either you're right back where you started with individual rates, or you're in double taxation, which is still going to result in a higher effect than the individual highest bracket. You've got state consideration come into this that is very significant. Now the difference is, because of that really low 21% rate, there can be some limited circumstances, whereas historically we've been at 60+% all day, every day. But you're going to grow a whole bunch of capital, which means you're not going to spend it, right? You're going to be in it for the long haul. Maybe service, trades, or business might have some implications, as long as you're not going to spend the money. But most our service, trades, or businesses spend the money, right? We want to get out of there. You've got risk issues too. You leave a bunch of money inside a C corporation. What happens if you have a casualty event? What happens if you get sued? It exceeds insurance. There's some real issues in there. But then in addition to that, not only are you going to have to grow a bunch of capital and not use the money, but then you're going to have to affect a stock sale on the back end. We do well over 100 M&A transactions every year, maybe 5, Tom, stock sales. And a lot of those are 338, 336. We treat them as asset sales because the person buying, generally, except in the public corporation world, they want assets. Why do they want assets? So they can depreciate it, so they can write it off. Somebody pays $20 million for stock, they got $20 million sitting in stock. And so, generally speaking, there's going to be some situations now where we would say never makes sense. Very, very, very seldom. Now, that very seldom got a little bit bigger. But it's not like what you're reading. It's not like what you're reading. We're going to talk about more of that in the corporations breakout. It's early. We talked about a little bit earlier. We've got 30 days, guys. All we have is code. There is going to be so much information that's going to come out. What we expect, anti-abuse rules, a lot of the planning considerations that we're even thinking about, they're probably going to get shut down pretty quickly, because at the end of the day, when you can take advantage of a tax law, they're going to be quick to shut it down. When the passive activity loss rules came out in 1986, it took easily a decade, maybe really 2 decades, to really get that all in the same place. And that's what we have with QBI. It might not even be here for a decade, which creates a whole other thing. But QBI actually helps make that statement that I just made a little bit more logical. All right, so we got to go. That being said, we've got questions. So for those of you that came in a little bit late, pay attention. This is on your table as well. We are here to get you answers. That being said, because of our comment that we keep saying all the time of it depends, notice our very specific caveat. You're going to see this a lot. Don't take action until you discuss your specific situation with your CPA. Don't walk out of here and be like, hey, I'm going to become a C corporation, or hey, I'm going to do this, I'm going to do that. Don't do it.
Blankenship CPA Group is a top 10 Nashville public accounting firm that serves our clients' tax, audit, accounting, and consulting needs in the Nashville, Tennessee, and Middle South market through our experienced accountants in our Brentwood, Dixon, Goodlettsville, and Mount Juliet offices. At Blankenship CPA Group, we are not just another CPA firm. Our culture is built on the values of biblical servant leadership, service over self, and exceptional engagement and execution. We believe in building a team of spectacular professional people that share this conviction. This mindset extends not only to our clients, but to our families and our community. Working with Blankenship feels different because our people and our firm is different.